For those of you who are self-employed, it's really important to understand how the banks view your financial statements. So you have kind of your gross turnover, you have your sales, you have your gross profit, and then your expenses, and then your net profit. I'll quickly explain what depreciation is. So if I have a car that's owned in my company name worth $50,000 and it depreciates in value by $10,000 a year, while it doesn't actually come out of my pocket as an expense, the bank acknowledges that I can claim that as an expense because my car has decreased in value. So even though I might have earned $100,000 that year, I only have to pay tax on 90 because of the assumed depreciation. You might have also heard about amortisation. Amortisation, let's say the name iChoice in my business was worth $500,000. I can also depreciate the cost of acquiring that business name if it was purchased in the first place. Depreciation and amortisation, the reason I mention it is that some of the banks will add that back. So if you made $90,000, they'll say, oh, well, hold on, that $10,000 depreciation on the car is a non-cash item. Let's add that back. So when the bank assesses your capacity to service a loan, they'll go off the $100,000 because they accept the $10,000 wasn't real. Some banks will not add back depreciation. Some banks will add back half of depreciation. Some banks, if you're in the earth moving business and you've got like a stack of depreciation, the banks might not add it back, or some do and some don't, because they acknowledge that the depreciation is a real cash item, because every 5 years you have to go and invest in more yellow goods as a real expense in the long term. So you might hear of how the banks look at EBITDA, which is earnings before interest, tax, depreciation and amortization. So the bank wants to know how much money you earn, and generally in most industries, they can add back these non-cash items, and that's the way the bank will look at it. But also, sometimes the bank will take the bottom line. Some banks will include undistributed profit. So if your company makes $300,000 and you only pull $100 out, some banks will not take the other $200 that's undistributed, that you just leave in there and pay the company tax rate and leave it there for a rainy day, or transfer it to a bucket company and use Division 7A to hold on to it for 7 years and have 7 years to do something with it. Well, it's not that important for you, because that's where we come into the picture. So when you come to us, we know how all the banks will view your financial statements, and that's kind of our job, I guess. But out of interest, if you want to know, a lot of banks will look at somebody's financial situation and not be able to help them, and the bank next door will be able to completely help them. Thank you.